listed at a premium and 34 of them listed at a discount.
Now it's up 43 points at the day's high.
Well, that was a day so far. You're with us here on a fresh new edition of Closing Bell Wednesday afternoon, and it's quite a morning and afternoon that we've had so far as we get into the last 60 minutes of trade. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleagues Rima and Nigel. Guys, hi, good afternoon.
Hi, good afternoon. Quite the choppy session, right,
Indeed.
today?
Decent pullback, right?
Yeah.
I mean, when we woke up earlier today, we were looking at all those negative cues. And I think this morning in our Bazaar chat, we were saying that if the Nifty can defend 19,550, we could see a potential bounce. So glad that worked out, right? We're 150 off the low point of the day, not out of the woods, but yet a bit of a bounce from the lows because the FI is a net short now. You had, the Brent crude prices that were up, the dollar index was up as well. So maybe some bit of a bounce back, and we've not seen that in the last few days. So good to see.
Absolutely. I mean, this is not a small pullback, especially given, the global context, which actually remains pretty adversarial. So it's a strong, we broke 19,600 early on. The low was, as Nigel said, about 19,550 or so. But look at what we've done since. We're back above 19,700 now. So that's a 0.25% higher. By the way, we're not alone. That's interesting. Asia, we had a pretty good session across most Asian markets. You look at what's happening in Europe, it's all green. Even US futures are indicating a slightly higher start, about 1/3%, but they're indicating a higher start. Maybe the reason is, and this started early on, within the first 1.5 hours of trading started, US futures, US bond futures, yields were slightly lower. Nothing large, but 2, 3, 4 basis points across the tenor, 2-year, 5-year, 10 and 30. Now, the futures during Asian session are not traded that heavily, but they kind of give you an indication. So, last night, the 10-year left off at 4.55, and this morning they were mildly lower. So perhaps markets hoping that, yields cool off at that 4.55 level, which is also, by the way, a significant resistance, as we've been pointing out. Now, for the Nifty, now that we've kind of had a very nice bounce back, we look ahead, right? There are two levels to watch. One is the 19,734 level, and then there is the 19,756 levels. 19,734 is the high that we saw, I think, day before yesterday, and 19,756 is the 20-day moving average as things stand right now. So those are the two numbers. Bank Nifty, I would still say, is looking a little more iffy as compared to the Nifty. That has been the case for the last couple of sessions. The resistance here is 44,778, which is the 61.8% retracement of the, the rise that we saw. And for the last 3 days, actually not yesterday, but 3 days prior to that, intraday, the Bank Nifty was taking that level out, but was not being able to close above it. That's the first level. And then there is a 20-day for the Bank Nifty, which comes in all the way at about 44,998 or so. So I would say in the morning we were saying that even if you get a session like yesterday and a close like yesterday, which was absolutely flat, it would be great. Absolutely something which one can live with. But it's done a lot better, especially the Nifty. Rima.
And you know what it's also done is that markets were making lower highs every single day for the last few days. And we can pull up that table from 20th of September when the intraday high in the Nifty was above 20,000. Then it started coming down, 19,850, then a close at a high of 19,700. Today, the intraday high on the Nifty is higher than yesterday's intraday high. So at least that trend has been broken. If you pull up the contribution plate, we've managed to recover despite weakness coming through in HDFC Bank and ICICI Bank. Those two heavyweights have a weightage of close to about 20-odd points on the Nifty. They're pulling us down by 30-odd points, with ICICI Bank down 0.65, HDFC Bank too down close to about 0.8%, and yet the markets have staged that pretty remarkable recovery intraday. Month to date, just want to highlight that India has broadly been quite the outperformer. The Nifty is up close to about 2.5%. The Midcap is up close to about 3%. This comes in the backdrop of very weak global markets. The Nasdaq is down, for instance, plunging 7% in the month of September. European markets, the CAC is down close to about 3.9%. You've got Nikkei, Hang Seng, Shanghai, all of them showing you cuts. So month to date, India has done quite well.
Okay, all right. Well, but I think we have a chat that we need to get to. Mark Mobius, founder of Mobius Capital Partners, joins us on the show. Hi, Mr. Mobius. Good afternoon. Thanks so much for joining us today. Well, Indian markets have done very, very well. But now, because of the spike in crude oil prices, maybe a stronger dollar index, and maybe because of valuations, there is some voices that are getting a little bit cautious on India. How are you positioned on the emerging market basket, and in particular with regard to weightage on India?
Well, we still have the highest weighting of our funds in India, and we will continue to be in that position because we see so many opportunities in India. Now, of course, there's going to be corrections along the way. We, of course, pay attention to that and have cash on hand to take advantage of these corrections. But we'd like to see maybe a 15, 20% correction before we dive back in. But nevertheless, we're holding on to what we have and adding on the margins because we believe that the opportunities in India are terrific. And the whole picture for India is so positive that it doesn't make sense to reduce our holdings in India.
All right, so India is the top bet. What's the difference between India and maybe the second bet? I mean, what is the current weightage on India?
Well, the current weighting now in India is about 20% and the next would be Taiwan. But as you know, Taiwan is having difficulties because of these problems with China and the US. So, we don't intend to increase very much there. Also on the list, Korea. We have a little bit in Thailand, a little bit in Taiwan, rather in Turkey. So these are very, very small positions. So the big one, of course, is still India.
Mark, hi, good afternoon. Got your view and you still remain very constructive. But let's just consider the global context, because a lot of people here are wondering if the global environment continues to deteriorate. When I say deteriorate, I mean the dollar is stronger. Say it goes to 110, right? It continues to appreciate, basically, the dollar index. If yields go higher, we had Jamie Dimon of JP Morgan here with us. We did an interview with him. He's kind of indicating of yields in the US heading higher, a lot higher. He says maybe the inflation fight is not done there. Oil prices are where they are, closer to 100 than they've been for a while now. In this backdrop, I mean, what should be the takeaway for investors? Really, are we saying that we will be largely insulated because of some of the structural drivers which are present here, unlike anywhere else? Is that the way to look at it?
No, not really. Of course, India is going to be affected by these changes you're seeing, particularly with interest rates. I mean, we can now, in US dollar terms, get 5% for deposits, 1 month deposits, which are quite remarkable when you consider where we're coming from. So this is very attractive, and it gives us thought for investing in equities when you may see things coming down. So there's no question that there's going to be a lot of angst when people look at these interest rates. However, I believe if you look at the money supply growth in America, you'll see that it's come down dramatically, the growth rate. And that means the Fed is unlikely to raise interest rates. If they do, it'll be a very, very small amount at all, if at all. So therefore, I think we're now at the peak of the interest rate cycle, and going forward, probably going to be coming down. So if we take a long-term view, it doesn't make sense to reduce our Indian holdings, given the fact that we're taking a 3 to 5 year view. Of course, for those people that have no cash, then it makes sense for them to reduce a little bit. But otherwise, India seems to be the place to be.
And is a lot of money still, according to you, I mean, of course, I mean, there's very few people as well networked as you, Mark, in emerging markets and amongst emerging market investors. Is there still a fair bit of sort of money waiting to deploy in a market like India?
Yes. You see, you must remember that for the global investors who must have exposure to emerging markets, they're really in a bind because they've had to get out of China, or their holdings in China have been wiped out to a great extent, and they have to look where else. Russia's out of the question. They've already lost 7% in Russia. Where do they go? It's India is the only other place. So that's the reason why I believe that you're going to see more and more money coming into India, simply because people have to get exposure to emerging markets, and India is the place to be within this emerging market spectrum.
Mark, is this 20% India weightage the highest ever in your portfolio? Is this the most bullish that you've been on India?
Yes, this is the highest so far.
Okay, and on an average, what's been the India's weightage, say in the last 5 years?
It's been anywhere between 5 to 10% in that range.
Okay.
And we've been increasing. Of course, we've been helped by the market as well. You must remember that the market has come up and our holdings in India have done very well. And so as a result, the weighting has increased.
Okay. All right. Mr. Mobius, what about, the banking space out here? I think the last time you spoke to us, you were not very gung-ho on the banking space, earlier this year. But now we have a couple of large banking names out here, namely HDFC Bank, that is giving you valuation comfort. What's your view? I mean, how are you approaching this space, given your weightage on India?
Usually, I'm not too keen on banks, simply because of transparency is not very good with banks, as you know. Very difficult to know where the bad loans are hidden. That's not a comment on HDFC. I think there are some incredible banks in India, but we're finding better value in the software area, in the industrial area, in the consumer area. So we prefer to be in those areas as well. One of the things to look at, by the way, is the bond market. The Indian bond market is expanding. As you know, JP Morgan, I think, have added India to their index, and that's going to be very positive for some of the banks. Of course, that's for sovereign bonds, but also bank bonds are probably going to do well going forward.
And I've got that. By the way, one of the things which people are expecting with India's inclusion in the JP Morgan bond index, Mark, you will have a one-stock adjustment of some $30 billion because India's weight eventually will rise to about 10%. And then annually, estimates are that this is, of course, into G-Secs, we'll receive about between $15 and $20 billion annually. So that's going to be a big deal. Only, of course, goes into effect middle of next year. But what that should do is reduce cost of capital, especially since we're talking about financials, especially those who are dependent on wholesale funding. Do you see that as a bit of a re-rating event for that sector? I mean, permanent reduction in cost of capital.
No question. This is going to help India generally because being in that index to begin with will put notice to people that they've got to be exposed to the Indian bond market. And of course, that'll filter down. The sovereign bond market will filter down to the industrial bond market in India. And that will be very good for companies. So I believe going forward, that's going to be something that we have to watch carefully because it'll be positive for India generally.
You gave us a view on U.S. interest rates. So let me just throw one more in on the global side. You said you think U.S. interest rates have peaked. What about oil prices, Mark? Do you have a firm view on where that is headed?
I think we're probably at the high point now. As you know, more and more people are switching to alternatives. And I think we're at the peak of oil prices. I don't see it going much higher, particularly with the strong U.S. dollar.
Mark, you started off by saying that you see tremendous opportunities in India. You want to take us through some of your recent India bets?
Well, as you know, we're still in persistent systems and a number of, we're looking at other software companies. So lots of opportunities.
Okay.
So you're looking to up your India technology exposure. You have persistent, but you're looking to add some more other IT stocks?
Yeah, what we're particularly interested in is the hardware area, because we believe that Indian hardware in this technology space is going to be very, very good going forward. So I think that's something we have to look at. We're waiting for listings, but I believe India is going to become a major manufacturer of semiconductors and other technology hardware.
Okay, all right. Mark, in the past, we've discussed a few stocks. I think Metropolis is a stock that y'all liked earlier. APL Apollo Tubes has worked very, very well for y'all. Anything more you'll have added, or have you trimmed positions on any of these?
No, those are the ones that we have and we continue to hold.
You know, just to pick up from what you said, right? You said you expect hardware to be a big theme. We have on the so electronics are the second largest import for India after oil. And the government, through its production-linked incentive schemes, is really incentivizing local companies to make a lot of what we import right now. I mean, these are everything from white goods to laptops recently, and many other items as well. And we've got lots of listings recently over the last couple of years. I mean, there is Dixon Technologies. I don't know if you track these. Amber Enterprises. There is Sirma, Keynes, and a bunch more. Have you or your team looked at these opportunities? Because that's one theme which is which perhaps has a secular run. Of course, you'll have to square that off again against valuations which have already which are north of 50 times for all these companies.
Yes, we're looking at these, but the problem is many of these companies are not or have not yet reached the return on capital criteria that we use. We look for at least 20% return on capital, and many of these companies have not reached that yet. So we're watching them very carefully and looking for opportunities. But one of the most important aspects of this whole picture is that the Indian government is going to have to allow more and more imports of components so that companies that are manufacturing these hardware products will be able to integrate these components and then re-export. So that's something we have to watch going carefully. But of course, more and more, there will be manufacturing of vital components in India.
Mark, a theme which has done exceedingly well in India are the ones tilted towards domestic growth. Government capex spending has been trending at more than 25%. Consequently, industrials, infrastructure, capital goods companies have doubled in stock price. Their valuations have gotten re-rated. And this has been happening for the last 12 to 18 months, perhaps even longer. Have you played this entire theme, or have you looked at it and shied away? Tell us your thoughts on this domestic industrial theme.
Yeah, we've looked at that. Unfortunately, many of these companies do not meet the criteria that we have as regards to return on capital and debt. Debt is a big, big issue. Some of these companies have too much debt. So we have to be very cautious when we look at them. Also, companies that are too much dependent upon government contracts can be quite vulnerable. So we prefer companies that have a variety of customer base, a big customer base, which could include the government, but also the private sector.
Mr. Mobis, what about gold? We have chatted about it in the past. With the current setup globally on equities, bonds, where does gold fit in?
I love gold. I think gold is a good thing. You've got to have some gold. Of course, many people say, oh, gold does not pay any interest, does not have any earnings. But at the end of the day, if you look at a long-term gold situation, you'll see that gold has been a great investment from the long-term point of view. By the way, a recent news article about Singapore's holdings of gold is very interesting because they have recently increased their holdings of gold pretty dramatically. So that's something to watch very carefully. And no question that governments around the world continue to hold gold and increase their holdings of gold. China is probably another good example.
Mark, one of the themes which has played out in so many sectors, this China plus one, as they call it, has been India taking the place which China is perceived to be vacating. Maybe they're not vacating, but what's your sense? Is that a permanent kind of a shift which has happened, or because it seems permanent when you're in the midst of it, but when you pull back and look at the bigger picture, what's the sense? What's your sense?
There's no question this is a permanent move on the part of companies around the world. But you must remember that China is still a huge exporter of products around the world, not only to the developed world, not only to Europe and US, but to the emerging markets world. So this is something to pay attention to. Of course, at the end of the day, what we're seeing is the growth rate of this trade. And of course, the growth rate of China, GDP, is slowing down. We're looking at maybe 3-4% growth for China going forward. But for India, the growth rate is much higher. So you're going to see India gradually coming up to equal China. I'm not going to say it's happening overnight, but it's going to happen within the next 10 years, I believe, at the rate India is going. But you must remember that China is still a huge market and a very, very important player globally in the trade picture. So we can't ignore it.
Mark, at the moment, how are you playing this manufacturing of technology, hardware, semiconductors in India? Or is this something that you're watching? Yeah, go ahead.
Yeah, what I'm doing is I'm watching it very carefully, looking at what companies are being listed and are already listed, looking at the numbers, and looking for a company that meet our criteria of return on capital and debt, et cetera. So I think, this is sort of a long-term kind of development that we're going to be seeing. And in the not too distant future, we're probably going to see an Indian type Apple or an Indian Microsoft or an Indian whatever in the tech area. And they're going to be big companies.
Just one last question, Mark. I mean, very near term, this U.S. government is sort of shut down business, the drama which plays out every few months. I mean, the deadline is this weekend. You think it'll get done? It always gets done. Any thoughts at all? Are you paying any attention to it?
I haven't been looking at it very carefully, but I think, there's so many things happening politically in the U.S. It's still something that we have to watch and take advantage of. But at the end of the day, I don't think it's something that we can really ride on in terms of the market movements.
All right, Mark, we'll leave it there. Thank you very much for joining us. It's always a pleasure for all of us to have you here on CNBC-TV18. Thank you for taking out the time, and thank you for speaking with us here. Thank you very much. So that's Mark Mobius, one of the most sort of astute watchers of emerging markets out there, still very bullish on India. 20% weight. That is a couple of percentage points higher than what India's weight is in the MSCI Emerging Market Index. So he is overweight, continues to be overweight. While we were in conversation with Mark, the markets moved up. The Nifty has moved up another 25, points or so, 20 points or so. So 19,713 is where we're at. We'll take our first commercial break here on this program. We're back. Vinay Jaising, Managing Director, Portfolio Management Services at JM Financial Services on the other side.
Welcome back. Let's get to some individual stocks. Ujjivan Small Finance Bank is surging in trade. This is on the back of a fresh brokerage note. Abhishek is here with the details. Abhishek.
Well, DAM Capital has written on Ujjivan Small Finance Bank. They have retained their buy recommendation and they have increased the target price by about 23% to about 61.5 from earlier target price of 50 per share that they had. So they met the chief credit officer, and the key takeaways from there is that the collection-led turnaround is seen in asset quality, prudently approaching growth and geographies as well. So bank will adopt measures to grow the MFI book at about 25% by FY24 from the 30% plus growth that they have right now. So bank can see the secured portfolio share in the overall loan mix increase towards the 40 to 50% level over the next few years. So Ujjivan is benefiting from a robust asset quality, strong collection efficiency and lower portfolio at risk for them, which can turn into NPA. Those are the kind of portfolio at risk which is on the lower side for Ujjivan. So DAM Capital expects ROA of about 3.4% and 3.2% in FY24 and 25 respectively, with sustained net interest margin as asset quality as well. And they expect the asset quality, which is one of the best amongst all the other SFBs, if you take a look at the comparison as well. Back to you.
All right, thanks a lot for that, Abhishek. So clearly the DAM Capital note has got the street excited on Ujjivan Small Finance Bank. I just want to highlight the other Ujjivan twin. That's Ujjivan Financial Services, which is also listed. Let's pull up that. That's a more than 500 rupee stock on. So is there a better opportunity out there, or is there an arbitrage opportunity available on Ujjivan Financial Services, the stock that's up for you on the screen? Why do I say that? We already have the merger ratio for the last many months. For every 10 shares of Ujjivan Financial Services Limited, you'll get 116 stocks of Ujjivan Small Finance Bank. So that's what the ratio is. And if you just plug in the numbers at current price, well, there's an arbitrage opportunity of close to around 17% in favor of Ujjivan Financial Services. So just highlighting this for our viewers. Most of the approvals, now looking at their filings, whether it's the RBI, whether it's the stock exchanges, and some part of the NCLT approval as well has come in. So a couple of more approvals, I think, are pending. When we have spoken to the management in the past, they have said by Q3, they see this merger flowing through. So, maybe in the time to come, we could see that narrow down. So just want to highlight this for our viewers. Ujjivan Small Finance Bank is buzzing on the DAM Capital note. And also Ujjivan Financial Services, there's a bit of an arbitrage opportunity out there, 16 to 17% arbitrage opportunity in favor of Ujjivan Financial Services. Just putting that on board.
Well, that's interesting, Nigel. Thanks for that. So that is the Ujjivan SFB and Ujjivan and the opportunity, as Nigel highlights. 55 points, by the way, on the index. We're at about 19,720. Vinay Jaising is Managing Director, Portfolio Management Services at JM Financial. He's with us with what he's making of things. Thanks very much, Vinay. Always a pleasure having you with us here. I don't know if you heard a little of what Mark Mobius was telling us earlier. 20% weight here in India, is an emerging market veteran and resolutely bullish in that sense, Vinay. What's your own kind of thought process in the slightly near to medium term with all that is happening globally?
So thanks so much for the opportunity. Yes, I did hear the interview. Very interesting. He comes, from one of the few, I guess, global fund houses wherein you have such a high overweight on India. If you look at the overall FII position in India 2 years ago, they were only about 20+% of India. Currently, it's gone down to about 18%. So they're relatively much more underinvested in India as compared to the past. Clearly, the dollar moving from 70 to about 82, 83 is being part of the pain. And they did take out, apart from this year, in the last 2 years, about $24, $25 billion as well. So there's an interesting 2% catch up for the rest of the world if they move, towards the way other FIIs are doing. And you could see as much as $80 billion coming in the next couple of months from that. Also, what's been very interesting has been the bond inclusion, the JP Morgan EM fund, which could get another $20 to $25 billion money coming into India. So good times of liquidity coming into the country. I think that's the first way to start. Having said that, India has been the best performing market in the last 3 months, 6 months, FITD. Overall, the world has gone up by only 2% FITD and India is up 16%. I'm talking about MSCI India. Small cap and mid cap are up 30%. So for a small amount of time, you could see some sideways movement, whether it's short term or medium term, a little difficult. But as the earnings trajectory keeps on moving towards India and everything's pointing to 15-16% CAGR in earnings this year and next, you'll start seeing, after probably a small time correction, you'll start seeing the markets also move northward, upward, as we move towards elections. And I think the next two key risks for us to look at is what happens, as far as crude oil prices are concerned, and the election outcome. All of them from short term to the next 12 months, a lot of action I think we would see as far as India is concerned.
All right. Good to hear your thoughts, Vinay, and thanks so much for joining in. Well, by the way, as we speak, we're having this chat with Vinay. We have the Nifty Bank that was under pressure. It was down more than 400 points in the morning. That's recovered and that's moved into the green. Remember, that one's playing out expiry today, given that it's a Wednesday. So the Nifty Bank is the one that's driving the Nifty higher. And also a couple of other stocks. You have HDFC Life and ITC. Both of them have moved to the high point of the day. Vinay, I believe that you're constructive on HDFC in particular. HDFC Bank, that's been a rank underperformer. If we pull up the Nifty year-to-date chart and we'll pull up, say, HDFC Bank, that'll tell you the picture out there. You're constructive. Would you be a buy on HDFC Bank at these levels? And what would be your broad time horizon? Because in the near term, there'll be some pressure on the NIMs, on the return ratios as well, and maybe on the asset quality front as well.
Thanks, Nigel. It's exactly what you said. We've seen a mammoth come up of HDFC Limited and HDFC Bank merger. The weightages and indices are obviously too high. If you look at, the large cap indices, they're as much as 13%. When you go to the 500, BSE 500, it's 8 to 9%. But MSCI India, it's about 5 to 6%. It is one of our largest positions in our fund. The reason why we've been buying or we own the stock is, one, valuations are our way. It's probably at a 5-year low in terms of price to book, about 2.6, 2.5 times. Very quality management, that's 2. Here we're talking about India relatively having outperformed its peers and valuations being a question mark compared to emerging market. Remember, we are at a 70% premium, and here there's a stock at a 5-year low. Third, if you look at what HDFC has done in its announcement with HDFC Bank, what we understand is HDFC Bank has been a little conservative in accounting, and courtesy the merger, you've started seeing the book reduced by about 4%, which is not a substantial number, and it's more a catch-up impact which will happen in the future. Also, I think the fourth point where I think the market is reading too much about it is the NIM contraction, partially on account of the amount of liquidity they had raised. Remember, it came at a time where the incremental CRR was raised by 10%, and that itself is weaning away. So you may see the market get pleasantly surprised when they see the loan book growth, which stood at 13% when you looked at the two companies together, inch up to 15 to 16%. Also, you start seeing liquidity improve in the banking system. Today, we are at net negative about 150 billion. But as that gets done, you'll see the costing pressure for HDFC also moving down. And I think you'll go back to better quality performance. It may take 2 quarters. We may be a quarter early for this, but I think this is something, considering where the market valuation is a must-own in one's portfolio.
Must-own in one's portfolio. Vinay, you own a bunch of defense names, Bharat Dynamics, BEL, MTAR, and they've done very, very well. Any changes, any additions? I mean, shipbuilders, for example, they started late, but they more than made up for the late start. Your Cochin and Garden Reach, etc. Since you have exposure here, have you kind of looked at expanding it, adding more names here?
We've incrementally, increased our cash position overall to about 9% currently in the NDPMS portfolio. Yes, these stocks have done well, and relatively valuations are still compelling for us to buy them. The story longer term or even medium term of a strong order book for the defense sector remains with it. Valuations at one time when we were buying it were at 15 times. Now they're at about 22 to 25 times. Even after a slight correction, MTAR is at 30 times. But the earnings trajectory for them is where we're excited for, and return on capital employed as well. So yes, we keep on nibbling at these stocks, but they are a sizable portion of our portfolio currently, and we are very happy to own them currently. We haven't added any new stocks in the defense name in our portfolio.
You said your cash holding is 9%?
That's right. In our NDP.
And this is higher than what you would typically have, right?
That is right.
So what positions have you trimmed in order to increase your cash holding?
We've trimmed a little bit of our energy space. We are now very underweight in energy. We've trimmed a little bit of our IT space, and where some of the stocks. Remember, we run a PMS, so individual stocks. When we buy it for some investors, some of the railway names, some of the defense names would have gone up to very high levels. So purely in terms of risk management, we would have trimmed a bit of that as well. It's interesting, we currently with this cash are looking at a lot of interesting names to buy. We are seeing some corrections happen on them, and we're looking forward to deploying it pretty shortly.
Do you want to tell us a little bit more about the stocks that you're evaluating or the themes that you're evaluating where the risk reward is reasonable?
Sure. There is a listing of a new IPO which we've started nibbling in the form of Concord Biotech, a global fermenter, very, very strong market shares both domestically and globally, great return ratios, bottom line growth, arguably between 25 and 30%. That's something we are looking at. We find that very interesting. One of the big banks we own that, and we keep on buying that is IDFC Limited. There's an arbitrage there with the bank as well of 15%. So a couple of interesting ideas between banks and the pharmaceutical space which we are looking at. One of our favorites is specialty chemicals, courtesy China, which is still not doing as well as we wanted to. Tatwa Chintan, we are looking at that pretty aggressively as well.
Always good hearing your thoughts, Vinay. Thanks so much for joining in and sharing all of them. Wishing you a good evening ahead and looking forward to hearing from you rather soon. Well, time to move on then. It's that time of the day when we shift our focus to D Street chatter. Nimesh is joining in to tell us what is he picking up in terms of dealing room action. Nimesh.
Hi Nigel, a smart recovery from the lows in today's trade. I guess it's also because of the expiry week. But this recovery is not backed by FI buying. That's the overall feedback. In fact, the largest institutions are better sellers, is what I understand as far as flows are concerned. For the first time in many days, some signs of small buying interest is back in the private bank stocks. So it's not showing up in the numbers, but clearly there is some bit of interest back in the private bank stocks. That's additional feedback. I guess from an expiry point of view, the feedback is maybe you'll see around between 19,500 to 19,700 level. So that's a broad ballpark as far as the expiry is concerned. But clearly today's pullback looks like it's largely short covering and not much buying support from the larger FIs.
All right, largely short covering. All right, Nimesh, but what about individual stocks? That's where the buzz is, right? What are you picking up today?
Well, in terms of individual names, the first stock on my list is Kalyan Jewellers. That stock is up in today's trade 3%, but the indication is there could be a very large block again in Kalyan Jewellers very soon. Remember, private equity investor Warburg has been a big seller, and looks like that another block is likely to come soon. So that's something to track in Kalyan Jewellers. The second stock is TVS Motors. Flat in today's trade, been consolidating in this very narrow range, but some bit of interest seems to be back. So the delivery volumes are going to be quite high in TVS Motors today, and there are buy flows. So that's the second one. The third stock is Campus Activewear. This is interesting. For the last many days now, there is an indication that a long only fund seems to be an active seller, and they're indicating blocks as well. So supply is coming in, and that's the reason why that stock has underperformed of late, and that's the case today as well. And the last stock is Axis Bank. As I spoke about, some bit of buying interest is back. Axis Bank actually had sell flows in today's trade, and even then the stock has moved up and is at day's high. Looks like some bit of HNI interest seems to be back, and looks like even the selling pressure seems to be over. So that's the reason why Axis Bank has moved up despite sell flows at FIDs today.
Okay. Being overshadowed by the demand here, the local desk, as Nimesh points out. So that's a good one. Nimesh, good list as always. Thank you very much for joining us and running us through stocks to watch out for. We'll take a quick commercial break here. As always, we'll get you what to buy or sell today for a reverse trade tomorrow. Our technical experts also join in after that with their respective trading ideas. Stay tuned.
Welcome back. Well, the markets are up close to around 50 points and there's a solid 160-point recovery from the day's low. A few stocks that are actually moving around. You have Havells that's moved to the high point of the day. The stock was flat just a few minutes ago. And FSL as well, that's First Source as well, has moved to the high point of the day. So individual stocks, they're doing a thing of their own, moving to the high point of the day. Mitesh Thakkar is back with us. Mitesh, give us a couple of your buy or sell trades.
So, Nigel, I have a buy on Godrej CP. I think that's one of the consumer products that's moved and reversed very nicely from lower end. So, buy here with the stop below levels of 985, look for targets of 1030. IOC is breaking down, so we'll take that as a sell or a STBT call. Keep the stop at about 92, look for targets of 88.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's move on then and focus on Morgan Stanley's note, where they have raised its target price on Indian IT stocks by around 11 to 29%. But on the other hand, you have Nirmal Bang that has cut its estimates. They believe that growth will be slower for longer and would sell into the FOMO rally. Rima's hopped across to the wall to give us this bull versus bear scenario. Rima.
Thanks so much for that. So you think of IT and immediately you would think about the outperformance that we've seen in IT stocks in the face of weak results. The question is, what next? Where does it go from here? And I'm here to present the bull versus bear argument on IT. So let me start with Morgan Stanley, which has raised the target price across all IT companies. The biggest price increase has been on Cyient, where the target price has been upped by nearly 29%, and it's followed by LTTS, L&T Technology Services, where the target price is up by 25%. On Wipro and Emphasis, the increase in target price is a bit more modest, 11 to 12%. So basically, between 11 and 29% is the increase in target price. The rationale given by Morgan Stanley is one, double-digit revenue growth in FY25, which according to them is higher than consensus. And secondly, they expect EBIT margins to improve starting Q1 FY25. But there is always a but, right? You've got Nirmal Bang, on the other hand, which has cut its FY25 estimates. They believe growth will be slower for longer and would recommend selling into the FOMO rally that we've seen on IT. Their argument is that market is taking the view that the worst is over and revenue and earnings will start accelerating sharply in FY25, driven by a stronger US economy. But Nirmal Bang is taking the macro call that US recession has been delayed, but they do believe it will happen in 2024. In fact, they're expecting a mid-single-digit revenue growth for IT companies in FY25, which is a contrast to Morgan Stanley, because Morgan Stanley is expecting a double-digit revenue growth. Nirmal Bang believes revenues will pick up only in FY26. They're also not in the camp about margins improving in FY25, as Morgan expects, because Nirmal Bang says the big deals that the IT companies have won, they've been fiercely there's been fierce competition in them, and they're priced to win. And just to underscore how divergent their views are on stocks, these are the target prices. As you can see, they're on the other end of the spectrum. On Infi, Morgan Stanley has a 10% upside, but Nirmal Bang sees a 15% downside. On HCL Tech, that's another one. Morgan sees a 15% upside, Nirmal Bang sees an 18% downside. And particularly, it's Tech Mahindra, which has seen a solid 25-26% rally year to date. The opinion is very divided. Morgan today has downgraded Tech Mahindra to an underweight from an equal weight, because they say the stock has seen a strong rally despite the earnings cut, which makes the valuations expensive. They have low confidence on growth revival in their telecom vertical, and any potential turnaround due to the management change, according to them, has been priced in. But you've got a Nirmal Bang, which has upgraded Tech Mahindra to an accumulate. So they're saying go out and buy. And that's because the margin expansion in FY26 may surprise on the upside under the new management, because it's starting off on a low base. So that's what they're expecting on Tech Mahindra. Back to you.
All right, Rima, thanks very much for that. So, yeah, I mean, two ends of the spectrum, literally, with as Rima highlighted, where Morgan and Nirmal Bang actually stand. That's what makes the market, I guess, right? Different views coming together. Sudeep Bandyopadhyay is with us. He's, of course, Group Chairman at IndiTrade Capital. Sudeep, good to have you with us here. Thanks for your time. Who do you kind of side with here on this debate on IT?
Well, Prashant, I think the reality, or the way I look at it, is somewhere between these two, I would say, rather extreme views. Morgan Stanley is, I think, really bullish. and somehow Nirmal Bang has a completely bearish view on the IT. But I think somewhere around 15% growth on an average for the IT sector is what we are looking at. So it's neither 29 nor negative. It's somewhere around 15%. We believe the challenges in the current fiscal came on account of order cancellations by a lot of US and European conglomerates. There were orders which were postponed, there were orders which were cancelled. So there were challenges in the current year, but things are looking up. I think the kind of recession the world was anticipating for US as well as Europe hasn't materialized, and things are getting into a stable zone. US, we are talking about things really not being a hard landing as such, and probably we are heading towards a soft landing in US. And if that happens, I think IT spending will pick up pretty soon. Also, what has happened is during COVID, a lot of outsourcing, a lot of IT work has been awarded to IT companies in India. They may not have gone to the larger IT conglomerates, but they have gone to the smaller, mid and small cap IT companies. So that's also an interesting area. There are some pockets of the technology sector like travel tourism, which is really booming. And the growth there has been phenomenal. If you look at companies in this space like a RateGain Technologies or a Coforge and all, they have a scorching pace of growth. Persistent Systems, on the other hand, has been working with manufacturing companies and getting more and more integrated. So Indian IT is a diverse basket, and overall we are expecting about a 15% growth as far as IT is concerned. There may be companies which are looking fully valued, but there are a lot of interesting pockets as well. And we believe that for a long-term investor, some of the good IT companies should definitely be in their holding basket.
Got it. All right. Hi, Sudeep. Good afternoon. Sudeep, my colleague Abhishek, before we went into that break, he was talking about Ujjivan Small Finance Bank. DAM Capital, they're very bullish on the stock, and it's moved to the high point of the day as we speak. Do you have a view on Ujjivan Small Finance Bank? And also, we put out a piece with regard to Ujjivan Financial Services, because it appears there's a bit of an arbitrage opportunity out there. Your take?
You're absolutely right, Nigel. I did hear your discussion on that arbitrage opportunity. Since the merger ratio has been announced and merger is around the corner, of course, an arbitrage opportunity is there. Now, this 17% which you mentioned, will depend on when the when the merger happens. Now, if the merger takes a little more time than what is being anticipated, probably the return will not be that much. So that's one uncertainty. But by and large, I think we have been bullish on this particular space, where the exposure to a great extent is on microfinance sector. Over the period of last few months, there has been tremendous improvement in microfinance business scenario overall. And we have seen both growth in loan book as well as significant improvement in collection. So the asset quality for pretty much all entities having microfinance exposure has significantly improved. And this has led to a positive outlook as far as the microfinance book is concerned. Ujjivan being one of them, and they have a large microfinance business as well, which has has shown tremendous improvement as far as asset quality and recovery is concerned. They also have got into a lot of secured lending business. So the future looks pretty bright. And, we have been positive on the entire small finance bank and microfinance companies. And I think Ujjivan definitely can be bought. And, if somebody wants to take that arbitrage opportunity, they can definitely do that as well. But by and large, this space looks good.
Sudeep, do stay on. We want to touch upon an important topic for everyone. NSE has plans to extend trading hours for the derivative segment in a phased manner. But what are the arguments both in favor and against this? Anuj is joining in for more on this. Anuj.
Well, the hot topic of discussion has been extending trading hours. Now, that's something which has divided the trader community, the traders and investor community. Look, what does the NSE want? The NSE wants to increase trading hours in phases. The first phase is to introduce an evening session for index futures and options between 6 to 9 p.m. and then take it further up to all the way up to 11:30 p.m., almost midnight, for which it has approval in place. After that, the extension has to take place in cash market, where they want to increase the timing from 3:30 to 5 p.m. Now, as I said, there's in principle not to do that, and exchanges have had that for a really long time, and they wanted to increase trading hours for a really long time. Now, what are the pros and cons? The arguments in favor essentially are that we need to align ourselves with global markets. There are a lot of times when the markets are reacting to news in the evening. For example, the US inflation data, the Fed announcements, the US market opening. So many data points come in the evening, and we only react early in the morning. That really is the biggest argument in favor of extending the trading hours. Now, the arguments against extending trading hours. It's impossible to align completely, right? I mean, then where do you stop? The Japanese market, for example, opens early in the morning, say at 5:30. Then do you start early morning session as well? Some markets are open on Sundays, for example. Then where do you stop? The other element here is the cost angle, especially for the brokerages, the smaller brokerages. The bigger brokerages can manage, but the smaller brokerages, their cost will double because they'll have to do double shift. So that's another reason against it. The work-life balance for traders and investors, that gets distorted. And there are a lot of traders and investors who do a lot of homework before the markets open and after markets close. So where will all that time come from? So there are arguments for and against that, of course. How things stand here right now, there was a Reuters report that the SEBI is studying it, yet to give a formal approval. They want the system to be ready. The sense I got was that it may not happen up until at least March of 2024.
Okay, all right, Anuj, thanks a lot for joining and giving us that quick update out there. Let's see whether or not that does come through or not. By the way, before we slip into a short break, pull up the intraday chart of Bandhan Bank. There's a large trade that's taken place at around 252 rupees odd. So I think that chart should come up for you. And in fact, we've seen a big volume spurt on that one as well. Stock is currently at the high point of the day. Slip into a short break, come back. We'll focus on markets and discuss a few stocks with Sudeep as well. Well, after a while, we're going to get an opportunity to say this. The markets are set to close at the highest level of the day, which hasn't been the case for the last few sessions. So 60 points higher, the final tick could be at the high point of the day. But one stock, Sudeep, that's not participated has been Vedanta. You know, the metal index, irrespective of how it's performed, they have a problem with regard to the promoter entity. And that's why that's a rank underperformer. What's your view on the stock? It's approaching $200 now.
Well, I think, last 6 months I've been advising investors to avoid this stock. There are challenges, and the challenges are real. They have the debt level at the parent company, holding company, which is a little unsustainable. And unless they're able to do some major restructuring or exit from some assets in one of the geographies, I think they are having a challenge. And pretty much the downgrade in the credit rating reflects that. To handle the situation, to handle the repayments which are coming up, they need to exit some assets. And the uncertainty would be around which assets they would exit. Whether it will be in India or some other geographies. Well, one of the Indian entities get impacted. I think these uncertainties are plaguing the counter. And under the circumstances, I think it's best avoided. Overall, also, I'm a little cautious on metals. With China economic recovery not being what it was thought of, I think it's better to be cautious overall on metals and definitely on Vedanta.
Okay, all right. Cautious view there. Well, Sudeep, we'll leave it there. Great chat as always. Thank you very much for coming in, and speak with you soon again. Well, 60 points higher on the Nifty. What a sea change as compared to where things were early on. So it's almost a 200-point recovery bounce from the day's lowest point, and it's a very, very good close. So not in line actually as compared to where the rest of the sort of Asia, what Europe is doing. Maybe a little better, but there was green across the board on the global screen as well. The cut from overnight did not percolate either in Asia or in Europe as well. Now it's got to follow through in the US. I mean, if you get a slam dunk session in the US, then in the morning it'll be long faces once again. But for now, it's a very good close. Look at the Nifty Bank. The Bank Nifty, by the way, will end absolutely flat. So yeah, that's the slight underperformer, 44,600. Slightly above 44,600 is where we are leaving on that front. The mid and the small cap part of the market, mid cap index will end 0.75% higher, so super strong, and the small cap index will end 1% up. The broader market really looking very, very strong. Market breadth is 1,200 higher, 1,000 stocks lower, so it's not wildly positive, but the advantage most certainly in mid and small caps is with the bulls. Rima.
Well, the Nifty Bank, though it ends flat, has recovered 400 points plus from the day's low. And it's ICICI Bank and HDFC Bank, which are going to end with cuts of more than 0.5%. But on the gaining side, the Nifty Pharma Index, the Nifty FMCG Index, the PSU Banking Index, they've all done well today. To run you through some of the big movers, L&T, Coal India, ITC, in the pharma names, Cipla, Sun Pharma, IT names like LTI, Mindtree saw buying. On the losing side, X of the two heavyweight banks, Grasim, Titan, Hero MotoCorp, State Bank of India ending with deep cuts. Okay, all right. So we're going to end at the high point of the day. The Nifty Bank is ending more or less flattish, and the mid-cap index up close to around 0.7%, which is very, very good news. A few more stocks, HCC, PFC, REC, they are flying away. And Bandhan Bank, we told you that a large trade took place.